So since the pandemic, we have been experiencing abnormal sort of macroeconomic and financial conditions. We've had a big fall in economic activity and big rebound that was done through a big support in monetary and fiscal policy. 2022 could be the start of a normalization in many respects. Global economic growth is expected to decelerate, but remain above economic potential, because we're going to see some offsetting factor. Obviously, we don't need as much fiscal spending, and therefore it will moderate across many regions as government retake control of their expenses. Monetary policy will remove past accommodation to fight inflationary pressure, because now we have inflationary pressure from these strong support. So these should be drag on growth going forward, but the real economy should improve. Inventories will be rebuilt from very low levels. Consumers will return to consuming more services like restaurants, travel, supported by strong job growth. And companies will also reinvest into new technologies and improve supply chains to bring more security to supply chain. So these should be supportive of growth. So net, that should leave us with a global growth of around 3.8%, 4% in 2022. After being above the last 2 years, we had been above consensus very strongly. Now we're a little bit below consensus on that front, but still a decent growth outlook. We should see also a peak in inflation, but it will remain above central bank's 2% target, forcing continued monetary policy renormalization. The reopening of the economy should normalize the demand from goods to services, which should alleviate the inflation in goods prices, such as cars, food, and commodities. But tight labor markets leading to higher wage growth and also higher house costs are expected to keep inflation from falling below the 2% target of central banks, which should lead central banks to continue to remove monetary accommodation. These projections obviously are based on underlying assumptions, which are very important, particularly for 2022, because there's a number of growing uncertainties. The evolution of the pandemic obviously is an important variable in any forecast. And here our assumption is that a combination of increased vaccination, higher natural immunity due to the large Omicron infection rate, and improved accessibility to new therapeutics will mean the world economy will live with the virus with limited economic impact. The other element of uncertainty is policy normalization, both from a fiscal and monetary, because they start from historically high level of accommodation. So the normalization of these policies will be tricky, and its impact on the economy more uncertain than usual. Just to give you an example, the Federal Reserve's balance sheet is currently close to $9 trillion, and that's from less than $4 trillion before the pandemic. So normalizing the balance sheet involves removing a very large sum of liquidity from the economy, which has never been done before. There's many geopolitical issues in 2022 that we'll need to keep an eye on. OPEC's normalization of oil production. We know that oil price is very high. Midterm election in the US, and obviously US-China relations, the competition on technology side could have an impact on financial markets. So we have an eventful year ahead of us, that's for sure. From an equity versus fixed income choice, you have peak economic growth, but peak inflation. That leads to continued corporate profit growth. Generally, that favors equity markets. But you have rising interest rates and medium to high valuation to equity, which will probably limit the upside in equity markets. But these fundamentals should lead to better fixed income return, but they're still uninspiring because rates are expected to rise modestly again this year, but you're starting from a higher level. So the return should be a bit more attractive this year than last year. From a regional perspective, the US is expected to face probably the stronger headwinds. The fiscal drag is the biggest in the US because they had done a lot of fiscal support. Fed policy is tightening more than elsewhere. You also have regulatory hurdles for the tech sector, and you have the midterm election. So there's a lot of headwinds for the US market. It'll be difficult to have a repeat performance and outperformance with these headwinds. On the extreme end, you have China, which is reversing its tightening of the last year and a half, and it's easing also regulatory issues. And the equity market there has strongly underperformed. So from a market's perspective, that could be an interesting place to be. The other element is on the sector side with a higher inflation, rising interest rates. We've started to see in early 2022 quite a big rotation out of growth and into value. And we think tactically, at least, there's still a little bit more of that to run for 2022. So investors should look into that. And finally, maybe on the fixed income side to boost and juice up returns, emerging market debt, again, has backed up quite a bit. Central banks have tightened quite a bit. So there's a bit more room over this year for emerging market debt to outperform.